Have you ever stopped to wonder, what really goes into creating the unique scent of your favorite perfume? Or maybe the perfect texture of that plant-based burger you tried? Or even the vital nutrients in your daily vitamin?
It's fascinating, isn't it? It turns out a lot of what makes these products special comes from this surprisingly intertwined world of ingredients, often hidden in plain sight.
Right. These aren't just simple components.
No, not at all. They are the culmination of, well, deep scientific research, a lot of sensory artistry, and incredibly complex supply chains. And increasingly, the companies behind them are, frankly, global powerhouses.
Exactly. So welcome everyone to a deep dive into one such giant dsm-firmenich AG, a new titan in that very global ingredient sector. This isn't just another company profile. It's really a fascinating story.
It is. It's about two giants, Royal DSM and Firmenich International SA, coming together. And they're basically reshaping the nutrition, health, and beauty industries as we know them.
So our mission today is to cut through the complexity of this huge new entity.
We'll unpack the strategic logic behind why they even merged in the first place, understand its unique position in the market.
Follow its financial journey, which has seen some, well, incredibly challenging times, followed by a remarkable recovery.
And look at the bold moves it's making right now to really focus its future.
Think of this as your shortcut, if you will, to understanding how a company like dsm-firmenich impacts almost everything, from your breakfast cereal to your skincare routine. And what makes this story so compelling right now?
Yeah, and for context, we're drawing our insights today from a pretty in-depth investment analysis framework that gives us a comprehensive, factual look at the company's journey and its strategy.
Okay, sounds good. So let's break it all down.
All right, to begin, let's maybe talk about the corporate profile, the very birth of this new industry leader. You mentioned it was a merger. It's often described as a merger of equals. Understanding the why behind it seems pretty foundational. Absolutely. The formation of dsm-firmenich AG back in May 2023, it was genuinely one of the most significant consolidations we've seen in the global ingredients sector for quite some time.
Okay.
It brought together two incredibly complementary forces. You had Royal DSM, a leader in health, nutrition, bioscience, deep expertise in vitamins, nutritional lipids, and those human milk oligosaccharides, HMO.
So those complex sugars like in breast milk for infant formula.
Exactly, now produced industrially to help support infant development. And then on the other side, you had Firmenich International SA. They were the world's largest privately owned fragrance and taste company, renowned for creativity, sustainable ingredients, a different kind of giant.
So the vision wasn't just about getting bigger, about sheer scale. It was something more strategic.
Precisely. It was about becoming an end-to-end innovation partner for the big consumer goods companies. That was the core objective.
Okay, end-to-end innovation partner. How does that actually change how they deal with customers? What does it let them do that, say, competitors can't match?
Well, it's a fundamental shift. They're moving beyond just being, an ingredient supplier. They want to be a true R&D collaborator. The aim is to provide a kind of one-stop shop so they can integrate taste, texture, health, and scent solutions all together. And honestly, that capability is pretty much unmatched at this scale by any single competitor right now.
So a customer could come to them with a really complex challenge, like, say, creating a new plant-based yogurt.
Perfect example. And dsm-firmenich can tackle the flavor profile, the mouthfeel, the nutritional fortification, maybe adding vitamins or probiotics.
And even advise on sustainable packaging, all under one roof.
Exactly. That's the vision.
And the structure itself reflected this merger of equals idea, right? Mm-hmm. Legacy DSM shareholders ended up with about two-thirds. 65.5%?
That's right, 65.5%. And Firmenich shareholders got the remaining 34.5%, plus a significant cash payment, too. $3.5 billion.
And the new company. It's Swiss domiciled, but the main stock listing is in Amsterdam.
Correct. On Euronext Amsterdam. It effectively blends its Dutch and Swiss heritage. It's a truly multinational entity with this kind of dual identity.
You mentioned a real-world impact example. The collaboration with Alpura, the Mexican dairy customer. How did that show this integrated approach in action?
Yeah, that's a great case study. They weren't just selling Alpura a flavor for a new product. They were providing the texture components, adding health ingredients like vitamins and probiotics, and even offering insights into sustainable packaging, that kind of holistic engagement. It creates much stickier customer relationships. It's not just transactional anymore.
Right, it becomes a deeper partnership.
Yeah.
Collaborative innovation.
Exactly. Which, ultimately leads to more resilient revenue streams for dsm-firmenich.
That really illustrates it well. And this distinct positioning, it seems even clearer when you look at how they've organized themselves post-merger into 4 specific business units.
Yes, these are really the pillars of their operation now. First up, you've got Perfumery and Beauty,
Yep.
P&B. This is where you find the global leader in fine fragrances, consumer fragrances, personal care ingredients, aromas. It covers the whole spectrum, from luxury perfumes down to everyday shampoo. And it's a big chunk of the business, almost $2 billion in revenue just in the first half of 2025.
Nearly $2 billion. Okay. Then there's Taste, Texture, and Health, TTH.
Right, TT8. This combines Firmenich's renowned taste expertise with DSM's huge range of food and beverage ingredients. So think flavors, enzymes, cultures, hydrocolloids for texture, nutritional ingredients.
For all sorts of applications, including plant-based.
Especially plant-based, that's a big focus. TTH brought in around $1.7 billion in revenue in H1 2025, also very substantial.
Got it. Next is Health, Nutrition, and Care Agency.
Yep, HNC. This division is all about science-backed solutions for human health. So dietary supplements, early life nutrition, like that infant formula stuff, medical nutrition, pharma ingredients.
Key products like vitamins, omega-3s, HMOs.
Exactly, those core health ingredients. HNC generated just over $1 billion in revenue in H1 2025.
And finally, the 4th pillar, Animal Nutrition and Health, A&H.
A&H. This is essentially the legacy DSM animal health business, focused on feed additives, vitamins, enzymes, things called eubiotics for animal farming. Still a big segment. $1.75 billion revenue in H1 2025.
But, and this is a big but, this brings us to a major strategic pivot, doesn't it?
It really does. The announced separation of this A&H business, it's a pivotal move.
Why are they doing it?
Well, the thinking is it de-risks the whole group from that sometimes wild vitamin price volatility we see in animal feed. It also reduces how much capital the overall company needs.
And sharpens the focus on those other 3 pillars, the higher margin, more consumer-facing segments.
Precisely. P&B, TTH, HNC. It's about focusing on where they see the most resilient growth and better profitability long term. It's a bold strategic choice.
It certainly sounds like it. Okay, so beyond the business units, what about their geographic footprint? You said global powerhouse.
Oh, absolutely. dsm-firmenich has a truly impressive global operational footprint. We're talking around 340 sites spread across roughly 60 countries.
Wow. And employing nearly 30,000 people. This network is critical. It lets them innovate and serve customers locally, right? Tailor things. But they still get the benefits of global economies of scale.
And the sales breakdown reflects that global reach. How diversified are they?
Very. If you look at their full year 2024 revenue, roughly 30% came from the rest of EMEA, so Europe, Middle East, Africa, excluding the home countries. North America was about 23%.
Oh.
Then you have significant exposure to high-growth emerging economies. Rest of Asia was 18%, Latin America 15%, China specifically was 9%. And then smaller percentages for the Netherlands and Switzerland.
So it's a real mix. Stable foundations in mature markets like Europe and North America, but also significant exposure to faster-growing regions.
Exactly. That balance is key to their strategy.
But that global presence must come with challenges too, right? Especially somewhere like China, 9% direct revenue is significant, but it's also a huge part of global supply chains for many industries. That's a really important point. It raises the question, how does a company like this balance the growth opportunities, say, in China, with the geopolitical risks? Because you have trade tensions, shifting regulations, local policies. It requires incredibly complex strategic thinking. We've even seen them make tough calls, like closing vitamin production facilities in China as part of their restructuring.
So it's not just about selling there. It's about managing the entire operational and political environment.
Absolutely. Navigating that dynamic, sometimes challenging operating environment is critical for their long-term success. It's a constant balancing act.
And leading this whole complex global operation, they've opted for a dual leadership structure, co-CEOs.
Yes, Geraldine Matchett and Dimitri DeVries. They lead the executive committee, which itself is balanced with executives from both legacy DSM and Firmenich.
Is that common in mergers this size? What's the thinking?
It's designed to ensure continuity and, crucially, a unified vision during what is a massive integration process. Merging corporate cultures, a public Dutch science company and a private Swiss family firm, is often the hardest part.
Right. It's not just about the numbers.
Not at all. And the dual headquarters, one in Kaiserach, Switzerland, and one in Maastricht, Netherlands, that's symbolic too. It honors both heritages. It's a statement of integration, not one side dominating.
Trying to minimize disruption while maximizing the combined strengths. Makes sense. Okay, so we have a clear picture of dsm-firmenich itself now. Let's zoom out and look at the industry they operate in. It really is a world of senses and science driving everything.
It is. And what's key for dsm-firmenich is that their main businesses, P&B, TTH, and H&C, are underpinned by some really robust long-term growth trends. These aren't just fads, they're fundamental shifts.
Let's take nutrition and health ingredients first. The numbers look huge. Over a $180 billion market in 2022, maybe $325 billion by 2031. That's like 7.5% annual growth.
Yeah, the growth trajectory is pretty impressive, and it's driven by several powerful megatrends converging. You've got rising consumer health consciousness, for one.
People wanting healthier options, clean labels, natural, sustainable.
Exactly. Plus, personalized nutrition is really taking off. People want solutions tailored to their specific needs. And of course, a massive shift towards plant-based protein. That requires a whole new toolkit of ingredients.
And specific niches are growing fast too, like gut health.
Definitely. Gut health probiotics, prebiotics, now even postbiotics is huge. Cognitive health ingredients, even specialized nutrition linked to things like the new weight management drugs, the GLP-1s. It's a very dynamic space.
Okay, what about fragrance and flavor, F&F? You described it as more consolidated, steady, non-cyclical growth, around 4 to 5.5%.
That's generally right. It's a big market, $36 billion recently. Growth comes steadily from demand for processed foods and also more sophisticated fragrances and personal care, home care products.
But there's a major trend here too, pushing for change.
Oh, yes. A really strong push from both consumers and regulators towards natural, sustainable, clean label fragrances and flavors. This is forcing a lot of R&D.
Into things like biotech and fermentation, green chemistry.
Precisely. Companies are scrambling to find innovative, sustainable ways to create these complex molecules without relying on, say, petrochemicals or resource-intensive natural extraction.
Makes sense. And the third area, beauty and personal care ingredients. Also healthy growth, maybe 4.56% CAGR.
Yep, another solid growth market, around $13–15 billion, driven largely by spending on skincare, hair care, cosmetics, with a real focus now on efficacy. Consumers want proof that products work.
So things like multifunctional ingredients, anti-aging.
Anti-aging is always big, and that whole clean beauty movement is pervasive. Natural, sustainable formulations are becoming table stakes. Asia-Pacific is the fastest growing region here.
What really strikes me is this convergence point you mentioned, health and wellness meeting sensory experience. Consumers seem to want it all now, healthy and delicious, effective and appealing.
That's the crux of it. It's the big challenge and the big opportunity. How do you make something taste great when you take out the sugar? How do you give a plant-based burger that satisfying texture and savory aroma?
It's not just about swapping ingredients.
No, it's about fundamentally reinventing how taste, texture, and health interact. This is where dsm-firmenich's integrated portfolio really shines. They can co-create a product, say, that plant-based food.
Using DSM's strength in protein and nutrition.
And combining it with Firmenich's mastery of authentic taste and aroma. That integrated capability, tackling both the health and the sensory side simultaneously, that's their distinct competitive advantage.
Right. It allows them to solve problems others maybe can't, or at least not as easily. Okay, let's talk competition. This isn't an empty playground. It's dominated by the big four.
You're absolutely right. The F&F and specialty ingredients sector is highly consolidated. The big four, that's dsm-firmenich, Givaudan, IFF, and Symrise, they collectively command a huge chunk of the market. Depending on the specific area, it could be anywhere from, say, 53% up to 80%.
Wow. They're formidable.
Very. Their scale gives them significant advantages in R&D, manufacturing, global reach.
Let's quickly profile the main rivals. Givaudan.
Givaudan is the pure-play leader in flavors and fragrances. Very strong performance. Their fragrance and beauty division grew over 14% like-for-like in 2024. As a result, they often trade at a premium valuation compared to the others.
Okay. Then international flavors and fragrances, IFF.
IFF has a very broad portfolio, bigger sales overall, around $11.5 billion in 2024. But they've been navigating their own massive integration. They bought DuPont's Nutrition and Biosciences unit.
Right, that was huge too.
It was, and it's led to challenges for them, high debt levels, some operational complexities that's impacted their valuation recently.
And the fourth one, Simrise.
Simrise reported about $5 billion in sales for 2024. They have a well-balanced portfolio across scent and care and taste, nutrition and health, generally seen as having a strong track record of profitable growth.
Are there other significant players besides these four?
Oh yeah. You have big agricultural processors like ADM and Cargill who have major divisions in food ingredients and animal nutrition. And then there are specialized regional F&F houses, companies like M&L, Takasago, Robert Ted, who compete very effectively, often in specific niches or geographies.
But going back to dsm-firmenich's unique edge,
Yeah.
it really is that combination, right? The depth and breadth across both the sensory side, taste and scent, and the nutritional side, health and wellness at that massive scale.
That's their key differentiator. No one else quite matches that specific combination at their scale. It allows for those integrated solutions we talked about.
Now, this industry seems prone to consolidation. M&A is a constant theme.
Absolutely. The dsm-firmenich merger itself is the biggest recent example of that drive for scale and creating more defensible integrated models.
What's the M&A scene look like right now in 2024, 2025?
It seems focused more on small to mid-sized deals. You see corporations divesting non-core assets to sharpen their focus.
Like dsm-firmenich is doing.
Exactly. And private equity is very active, particularly in carving out specialized businesses they think they can grow independently.
So dsm-firmenich's strategy of integrating the big merger while simultaneously tuning the portfolio through divestiture, selling the yeast extract business, marine lipids, that Robert Ted stake. It fits right into this industry trend.
Perfectly. It's proactive portfolio management, all aimed at focusing on those higher growth, higher margin core areas. It's key to their transformation story.
Okay, one more crucial industry factor, the regulatory landscape. This sounds incredibly complex and must be a huge barrier to entry.
It absolutely is. Navigating the global web of regulations is a critical operational requirement, and it definitely creates a competitive moat. The rules vary significantly by region.
How so? Let's take Europe.
Europe, through bodies like EFS, European Food Safety Authority, and ECH, European Chemicals Agency, tends to be the most rigorous. They have a very science-based pre-approval process for food additives, think E-numbers. Everything needs extensive safety data, and their cosmetics regulations are famously strict, banning or restricting over 1,300 chemicals.
Wow, 1,300. How does the United States compare?
The U.S., under the FDA, has a couple of main pathways for food ingredients. There's the formal food additive petition requiring pre-market approval, but there's also the generally recognized as safe or GRAS notification system. If there's scientific consensus on safety, it can be used without formal pre-approval. Labeling is also tightly controlled.
And Asia. Sounds like a patchwork.
Highly fragmented is the word. You have efforts like the ASEAN Cosmetic Directive trying to harmonize rules across 10 nations, but implementation varies. And major markets like China under NMPA, Japan, MHLW, South Korea, MFDS, they all have their own distinct, complex, and often evolving regulatory systems for ingredients, product registration, labeling. It's a minefield to navigate.
So this demanding, constantly shifting regulatory environment, it really favors the big players, doesn't it?
It absolutely does. The sheer investment needed for toxicological studies, preparing complex dossiers, ongoing compliance monitoring, it's immense. Large, well-capitalized companies like dsm-firmenich, Givaudan, IFF, Simrise, they have dedicated regulatory affairs teams, deep expertise, the resources to handle it.
It's a barrier that reinforces their market position.
Exactly. While it's a challenge for them too, it's an even bigger hurdle for smaller competitors or potential new entrants. It locks in the advantage of scale and experience.
Okay, that industry context is vital. Now let's really dig into the numbers. Unpack the post-merger financial performance of dsm-firmenich. You framed it earlier as a story of resilience.
It really is. A clear narrative of challenge followed by a pretty impressive recovery. To see the trend, we need to look at the pro forma financials, basically, combining DSM and Firmenich's results as if they'd been one company earlier.
So what was the baseline? Pro forma 2022.
Pro forma 2022, the combined entity generated sales of about $13.2 billion and adjusted EBITDA of nearly $2.3 billion. That gives a margin of around 17.2%, a solid starting point.
But then came 2023,
Huh.
a really challenging year, you said. Sales fell, profitability dropped significantly.
Yeah, 2023 was tough. Sales declined about 7% to 12.3 billion, but the bigger hit was on profitability. Adjusted EBITDA fell a substantial 22%, down to 1.78 billion. The margin compressed quite a bit, down to 14.4%.
What drove such a steep decline? It wasn't just market softness.
Two major factors, really. First, as we touched on, an unprecedented cyclical low in vitamin prices, particularly impacting the ANH business. That alone was estimated to be around a 500 million negative hit to EBITDA. Massive!
€500 million just from vitamin prices. Wow.
Yeah. And second, the whole industry got hit by this deep, widespread customer destocking cycle. Customers had built up inventory in 2021, 2022, then slammed the brakes and aggressively reduced stock in 2023. That crushed order volumes, particularly in H&C and ANH.
Okay, so a perfect storm of low vitamin prices and customers just not ordering. But then a strong rebound in fiscal year 2024.
A very strong rebound. Sales were up 4% to nearly 12.8 billion. But adjusted EBITDA surged 19% back up to over 2.1 billion. The margin recovered nicely to 16.5%.
That's quite the turnaround. What fueled that recovery?
Several things came together. Market conditions started to normalize as that destocking cycle finally ended. Crucially, their internal self-help program started kicking in the merger synergies they were targeting, plus a separate, very effective vitamin transformation program aimed at improving efficiency in that business.
Okay.
And then interestingly, there was a temporary spike in vitamin prices late in the year, Q4, because a competitor had a fire and supply disruption. That provided an extra boost.
So a mix of market normalization, internal improvements, and a bit of luck with competitor issues.
Pretty much sums it up. And that positive momentum carried right into the first half of 2025.
How did H1 2025 look?
Continued progress. Sales up another 3% year over year, reaching 6.5 billion for the half. But adjusted EBITDA jumped a really impressive 29% to 1.26 billion. That pushed the margin up significantly to 19.4% for the first half.
Almost 20% margin.
Yeah.
That really highlights the operating leverage, doesn't it?
Yeah.
Once things normalize, profits bounce back hard.
Exactly. It shows that the underlying profitability of the core businesses is strong. The massive swings we saw in the group's overall earnings were largely driven by that volatile ANH vitamin cycle and the temporary, though deep, destocking effect.
Which strongly validates the strategic decision to separate ANH, right, to get a more stable financial profile.
Absolutely. Removing that volatility is expected to make the remaining company's earnings much more predictable and likely more highly valued by the market.
Okay, that makes sense at the group level. Now let's dive a bit deeper into the individual segments. How did each pillar perform through this period? That really tells the story.
It does. Let's start with Perfumery and Beauty, P&B. This was really the standout performer throughout. In 2024, it delivered strong 7% sales growth and 13% EBITDA growth, achieving that excellent 22.3% margin.
Very strong. You mentioned a slight decline in H1 2025, though.
Yes, but context is key. It was compared against a very strong first half of 2024, and the dip was mostly due to some softness in high-margin sun care ingredients. The core perfumery part of the business actually remained quite robust, showing underlying strength.
Okay, how about Taste, Texture, and Health, TTA?
Also, very strong performance. Good 7% sales growth in 2024, and that momentum continued into 2025, supported by solid volumes, and importantly, they started seeing success from cross-selling integrated solutions, those sales synergies kicking in.
Good to see the merger logic playing out there. What about Health, Nutrition, and Care, H&C?
H&C had a weaker 2023 and saw a slight size decline in 2024. This segment was probably hit hardest by that destocking, especially in dietary supplements. However, momentum really picked up in the second half of 2024 and especially into H1 2025. In that first half, EBITDA grew 11%, and the margin improved significantly by 200 basis points, reaching 17.9%. So a good recovery underway there.
And on the roller coaster, Animal Nutrition and Health, ANH.
Exactly. A perfect illustration of the volatility. Profitability just collapsed in 2023. The margin was only 4.0%. Then a massive 168% rebound in EBITDA in 2024.
Wow.
And that was amplified even further in H1 2025, with the margin hitting 19.5%, largely thanks to those temporary vitamin price spikes we talked about.
It really underscores why they want to separate this business. That kind of swing makes planning difficult.
Hugely difficult. It obscures the performance of the more stable core businesses. Okay, so beyond the profit and loss, let's look at the balance sheet. A strong balance sheet provides crucial flexibility, especially during a major transformation like this.
Right. How does their debt profile look?
As of end 2024, total borrowings were around $5.28 billion. It's mainly long-term debenture loans. They've been active managing this, for example, issuing a new $750 million 11-year bond in early 2025 at a pretty attractive rate, just under 3.4%. Shows they have good access to capital markets.
And their net debt, leverage levels.
Reported net debt was $2.56 billion at the end of 2024. S&P estimated their adjusted debt to EBITDA ratio, a key leverage metric, was healthy, somewhere between 1.7x and 1.9x for 2024. That's comfortably within management's target range of 1.5x to 2.5x reported net leverage.
Do they have good credit ratings?
Yes, solid investment grade ratings. A3 from Moody's and A from S&P, both with stable outlooks. That's important for keeping borrowing costs down.
And you mentioned something about flexibility. No financial covenants on their bonds.
That's a key advantage. It means they don't have strict financial ratios they need to meet to avoid defaulting on their bonds. It gives them significant operational and strategic breathing room to fund the integration, the restructuring, investments, and shareholder returns without feeling financially constrained.
That sounds really valuable during this period. Okay, what about cash flow? Ultimately, that's what pays the bills and funds growth.
Their cash flow generation showed a marked improvement in 2024, which is exactly what you'd want to see after the tough 2023.
How much did it improve?
Their adjusted gross operating free cash flow jumped 55% in 2024, reaching over $1.55 billion, up from about $1 billion in pro forma 2023.
That's a big jump, driven by the EBITDA recovery.
Mostly, yes. The strong rebound in profits was the main driver, but they also managed their working capital pretty well, particularly bringing down inventory levels from the highs seen during the supply chain crunch.
And their cash conversion. How much of their sales turned into cash?
Excellent conversion in 2024. Their cash-to-sales ratio hit 12.1%, which actually exceeded their own midterm target of over 10%.
But H1 2025 was weaker on cash flow.
It was, yes. $215 million compared to $460 million in H1 2024. Management attributed this mainly to the timing of certain payments, like higher employee bonuses related to the strong 2024 performance. They seem confident they'll still hit the full-year target, as cash flow tends to be stronger in the second half.
Okay. And working capital itself, still quite high.
It was $3.8 billion at the end of H1 2025, which is nearly 30% of sales. That's an area they've flagged for improvement. They're committed to structurally reducing that percentage over time, which should free up more cash flow in the future.
All right. We've seen the financials recover. Now let's focus on where they're heading, the strategic direction and how they're deploying capital. This is really about actively reshaping the company's future.
Absolutely. And the single most significant strategic move, as we've discussed, is that comprehensive portfolio optimization spearheaded by the A&H separation.
They announced that early 2024. What's the core rationale again, just to be clear?
The fundamental thinking is that A&H operates in very different markets, has different dynamics, different capital needs compared to the consumer-focused businesses, and management concluded it could achieve its full potential better under a different owner.
And for the remaining dsm-firmenich, what does the separation achieve for them?
Several key things. One, significantly reduces exposure to those volatile vitamin earnings. 2, lowers the overall capital intensity of the group. A&H requires significant investment. 3, sharpens the strategic focus squarely on P&B, TTH, and H&C.
Where are they in that separation process?
According to recent updates, it's well advanced and entering the final stages as of mid-2025. A huge milestone was completing the sale of their stake in the Feed Enzymes Alliance with Novonesis. That brought in $1.5 billion in cash just in June 2025.
So concrete progress. And beyond A&H, they're actively tuning the portfolio with other divestitures too.
Yes, it's not just A&H. They've been consistently selling off smaller non-core assets. We mentioned the yeast extract business sold to La Safra, the marine lipids business to KD Pharma Group.
And that minority stake in Robertet, the fragrance competitor, for around $400 million.
Exactly. All these moves align with that strategy. Concentrate resources and management attention on the core, high-growth, high-margin segments. It's very disciplined.
And this disciplined approach extends to how they allocate capital, right? R&D, capital expenditures, CapEx, and M&A.
Precisely. Innovation is positioned as the central pillar for growth. You can see that in their R&D spending.
How much are they investing?
Nearly $800 million in 2024. That's 6.2% of their sales. And it was actually up from 2023, showing continued commitment even during the transformation.
Where is that R&D focused?
They have over 2,000 scientists across 20 global sites working on key platforms. Big focus on biotechnology, especially precision fermentation. Microbiome research is huge for them. Receptor biology, understanding taste and smell. And increasingly, using AI and data science to speed up discovery.
So that level of investment is crucial for creating those unique proprietary ingredients that give them an edge.
Absolutely, it's fundamental to staying ahead. They're also investing significantly in capital expenditures, CapEx.
This is for factories, equipment.
Yes, upgrading their manufacturing footprint, improving supply chain resilience, and adding capacity for future growth. They spent $764 million on CapEx in 2024 and another $401 million just in the first half of 2025. So substantial investment there too.
And their M&A strategy. Are they looking for big deals or smaller ones?
The focus now seems to be on value-accretive, bolt-on acquisitions, smaller deals that enhance their existing capabilities or give them access to new technologies and core areas.
Like the Adair Biome acquisition.
Exactly. That brought in postbiotic technology, boosting their position in the high-growth microbiome space, or increasing their stake in Andre Pectin, a texture ingredient specialist. It's about targeted additions, not massive transformations via M&A anymore.
This is like a flywheel approach. Sell non-core assets, use the cash to pay down debt, return some to shareholders, and reinvest the rest in R&D and these smart bolt-on deals.
That's a great way to put it. It creates this virtuous cycle, strengthening the core, improving the financial profile, and funding future growth. It feels quite disciplined compared to maybe riskier strategies.
And part of that cycle is returning capital to shareholders. How committed are they to that?
Very committed, it seems. They aim for attractive returns through both dividends and share buybacks.
What's their dividend policy?
The stated policy is a stable and preferably rising dividend, and they back that up by proposing and paying a stable $2.50 per share dividend for 2024, even amidst all the transformation and challenges. That builds on legacy DSM's long history of consistent payouts.
Provide some stability for investors. And they launched a big share buyback program too.
Yes, a major one. Leveraging those divestiture proceeds, they launched a 1 billion share repurchase program in April 2025. The stated goal is to reduce the number of outstanding shares, and they plan to complete it by early 2026.
€1 billion is significant. What does that signal?
It's a strong signal from management. It suggests they believe their shares are currently undervalued by the market, and it's an efficient way to return that excess cash generated from divestments directly to the remaining shareholders. Shows confidence in the future.
Okay, so they're reshaping the company, investing strategically. Where do they see the biggest growth opportunities coming from? You mentioned they're aligned with megatrends.
They absolutely are. Their core portfolio, post-A&H separation, lines up almost perfectly with three dominant global consumer megatrends that are reshaping food, beverage, and personal care.
What's the first one?
Health and wellness. This is huge. It's this profound shift towards proactive health management. People want fortified foods, supplements, clean labels, less sugar, less salt.
Products with tangible benefits.
Exactly. And their H&C and TTH divisions are right at the heart of this, providing the vitamins, the probiotics, the nutritional lipids, the taste modulation tech that makes healthier products possible and palatable.
That's a massive tailwind. What's the second megatrend?
Sustainability. This is no longer niche. Consumers, especially younger ones, are increasingly making choices based on environmental and social impact.
So demanding natural, renewable ingredients, sustainable sourcing, transparent supply chains, lower carbon footprints.
All of it. And dsm-firmenich's leadership in areas like biotechnology, green chemistry, and their portfolio of natural and biodegradable ingredients, things like Clearwood, which is a biotech alternative to patchouli, or their Furgutty collection made using gentle extraction, positions them as a key partner for brands wanting to boost their sustainability credentials.
It's becoming a requirement, not just a nice to have. And the third trend?
Premiumization and enhanced experiences. As disposable incomes rise, particularly in emerging markets, consumers are willing to pay more for products that offer superior performance, unique sensory experiences, or even just a touch of affordable luxury.
So P&B benefits from demand for fine fragrances, high-performance active beauty ingredients.
Right. And TTH benefits from demand for novel, exciting flavor profiles or textures that elevate everyday food and drinks. It's about delivering more than just the basic function.
And innovation is the engine driving their ability to capture these trends.
It's the absolute lifeblood. Their organic growth depends on it. We talked about their R&D investment. It fuels several key science platforms.
Like biotechnology and fermentation.
Yes, that allows sustainable production of vitamins, HMOs, even complex fragrance molecules, reduces reliance on traditional chemistry or volatile natural resources. It's more resilient, often greener.
Yeah, microbiome science, you mentioned gut and skin.
They're a leader here, developing clinically proven pre, pro, and postbiotic solutions. Things like Humiomi, they're showing links between gut health and immunity, mental well-being, metabolic health. It's a fascinating area.
Receptor biology and sensory science sounds like understanding taste and smell on a deeper level.
Exactly. How does the brain perceive sweetness or a particular aroma? Understanding that allows them to create really effective taste modulators for sugar reduction or fragrances that are truly impactful and long-lasting.
And they're using AI and data science too, not just traditional lab work.
Increasingly so. To accelerate the discovery of new molecules, predict how formulations will perform, analyze consumer trends, basically getting innovations to market faster.
Can you give examples of recent innovations coming out of these platforms?
Sure, they've launched things like Ampli-D, which is a faster-acting form of vitamin D Life's Omega, a sustainable omega-3 sourced from algae instead of fish oil, and in beauty, Eaterwell Hair, an ingredient for scalp health based on senolytics basically targeting aging cells. Shows the breadth of their science.
Now, a core part of the merger logic was cross-selling and revenue synergies, right?
Yeah.
Leveraging the combined portfolio. How is that panning out?
That was, and still is, a central pillar of the investment case. They're targeting $500 million in incremental annual revenue from these synergies, which should translate to about $175 million in extra adjusted EBITDA each year once it's fully running.
And how do they actually capture these? What does that look like in practice?
Primarily through offering those integrated solutions we discussed, being a single partner for complex projects involving taste, texture, health, and scent. That Alpura dairy example is perfect, solving multiple problems at once.
Right.
Also through capability sharing, bringing Firmenich's consumer insights to DSM's customers, and DSM's health ingredients to Firmenich's clients, and leveraging the combined sales force for better geographic reach.
Are they seeing results yet?
They are. They reported about $50 million in revenue contribution from these synergies in 2024 and said the project pipeline is growing steadily. The bulk of the synergies, around 60%, are expected in TT, then 25% in HNC, and 15% in P&B. So it's happening, but it takes time to build.
And finally, geographic expansion, especially in emerging markets, still a key growth driver.
Absolutely. Asia and Latin America already account for over 40% of their sales, and these are the fastest growing regions for food, beverage, personal care, fueled by urbanization, rising incomes, growing middle classes.
So the strategy is to use their global footprint and local innovation centers like the one in Singapore to create relevant solutions for those specific markets.
Exactly. You can't just sell the same thing everywhere. You need to tailor flavors, textures, even product concepts to local preferences. Having that local presence combined with global R&D scale is key to capturing that growth.
We've painted a picture of strategic repositioning and future growth, but it's crucial to remember the recent past. The period around the merger, 2022 to 2024, wasn't smooth sailing. They faced some significant recent challenges and headwinds.
That's absolutely right. It was a really tough operating environment. First off, you just can't underestimate the sheer integration complexity and execution risks involved.
Merging two massive global companies with very different histories and cultures.
Exactly. DSM, public, Dutch, science-based roots. Firmenich, private, Swiss, family-owned for generations. Integrating cultures, IT systems, business processes, aligning strategy across 30,000 people. It's inherently complex.
And doing that while the external market was in turmoil? That must have been a huge management challenge.
Immense. Then you had the external pressures. Inflationary pressure on raw materials was intense in 2022-2023. Costs for everything, raw materials, energy, transport shot up.
Putting pressure on margins.
Yes, because you can't always pass those costs on to customers immediately. There's often a lag. It squeezed profitability across the industry.
And supply chain disruptions added to that. Things were still messy post-pandemic.
Very messy and volatile. The vitamin market was a prime example. We saw dsm-firmenich restructuring its vitamin operations, closing facilities in China in 2023. Then in 2024, that competitor fire in Germany caused sudden price spikes for vitamins A and E. It just highlights how fragile supply chains can be.
Then there was the customer destocking cycle in 2023. You said that hit hard.
It had perhaps the deepest impact that year. Customers had overordered in 2021-22 to protect themselves. Then they slammed the brakes and worked through that excess inventory in 2023. Order volumes just plummeted for ingredient suppliers, especially in HNC and ANH.
But that cycle eventually ended.
Thankfully, yes. By 2024, order patterns started normalizing, which led to that volume rebound we saw in their results. But 2023 was painful because of it.
What about currency headwinds? As a global company, they must be exposed.
Definitely. They report in euros, but have huge sales in US dollars, Swiss francs, other currencies. When the euro or Swiss franc strengthens, those foreign earnings translate back into fewer euros.
Did that have a noticeable impact?
Yes, particularly in 2023 and 2024. They estimated about a 50 million negative impact on EBITDA just from FX in 2024, and another 25 million hit in the first half of 2025 alone. It's a constant factor they have to manage.
And geopolitical tensions, particularly around China.
That creates ongoing uncertainty. With 9% of sales directly in China, plus significant manufacturing and sourcing there, they're exposed to shifts in trade policy, tariffs, potential disruptions. It's a risk factor for any global company with that kind of footprint. European firms generally have noted their reliance on Chinese inputs.
Finally, economic slowdown and discretionary spending. Does that affect them?
It can, although much of their portfolio is quite resilient food, health ingredients tend to hold up well. But the perfumery and beauty segment, especially fine fragrances and premium beauty, does have exposure to discretionary spending.
So if there's a major economic slowdown, people might cut back on luxury scents or high-end skincare.
Potentially, yes. They might trade down or buy less often. Although historically beauty sometimes benefits from the lipstick effect, people still buy small treats even in tough times. So it's a mixed picture, but definitely a sensitivity for the P&B part of the business.
Okay, so they navigated that storm. Now let's talk valuation. After all this transformation, how is the market valuing dsm-firmenich? What does this all mean for its value?
Right, the crucial question. A common starting point is comparing trading multiples versus its peer group, looking at metrics like enterprise value to EBITDA, or price to earnings, PE, against their closest competitors.
And the key peers here are Givaudan, IFF, and Symrise.
Exactly. When you do that comparison, a clear pattern emerges. Givaudan consistently trades at a significant premium. Their EBITDA multiple is often in the low to mid-20s range.
Why the premium?
It reflects their status as the pure-play leader in flavors and fragrances, their strong track record, high margins, and consistent growth. The market rewards that predictability.
Okay. How does dsm-firmenich compare, trading at a discount?
Yes, currently trades at a noticeable discount to Givaudan. Depending on the source and exact calculation, its recent EBITDA multiple has been reported in a range of, say, 14x up to maybe 19.5x, so significantly lower than Givaudan.
And IFF, also discounted.
Yes, IFF's valuation has also been compressed, often trading in a similar range to dsm-firmenich, maybe around 16 by 16.5x recently. That's largely attributed to their high debt levels and the ongoing complexities of integrating that massive DuPont N&B acquisition.
Symrise fits in between.
Generally, yes. Symrise usually trades somewhere between the levels of IFF and dsm-firmenich and the premium multiple commanded by Givaudan.
So what are the main reasons for the dsm-firmenich discount compared to Givaudan?
It seems to boil down to a few key factors. Its historical conglomerate structure, which the market often discounts, the earnings volatility and lower margins historically associated with the animal nutrition and health business they're now separating, and frankly, the perceived execution risk that comes with any large-scale merger integration.
So a core part of the investment thesis is, if they successfully separate ANH and prove they can consistently perform with the focused portfolio, that valuation gap should narrow over time.
That's precisely the bull case, that the market will eventually recognize the higher quality and stability of the remaining business and re-rate the stock closer to its pure-play peers.
Okay. Given this complex structure and the ongoing changes, is some of the parts SOTP analysis useful here?
Extremely relevant. SOTP is often used for multi-divisional companies or those undergoing big portfolio shifts. It tries to value each piece of the business separately.
How does that work practically?
You essentially try to value each segment as if it were a standalone company. So you'd look at P&B with its high margins and strong market position and value it against pure play fragrance beauty peers, maybe justifying a multiple closer to Givaudan's fragrance arm.
Okay.
Then you'd value TTH, looking at flavor and food ingredient peers. Its strong growth and synergy potential would support a robust multiple, perhaps like Symrise or the higher end of food ingredients.
An HNC, valued against nutrition pharma ingredient companies.
Right, highlighting its exposure to growth areas like medical nutrition and supplements. And finally, you'd value A&H against animal health and feed additive companies, though its valuation would likely be moderated by that vitamin cyclicality. That $1.5 billion sale price for the Feed Enzymes Alliance provides a useful data point for part of A&H.
So the point of SOTP is to see if the sum of the individual parts might be worth more than the current market value of the whole company. It can highlight hidden value.
Exactly. It helps assess if the market is fully appreciating the quality of each individual business unit, especially those high-margin P&B and TTH segments, which might be overshadowed by the legacy conglomerate structure or A&H's volatility.
Makes sense. Beyond multiples and SOTP, what about basic cash flow and dividend yield?
Also important valuation supports. We saw their strong free cash flow generation in 2024, that $1.55 billion. On their market cap of around $28 billion, that translates to a trailing free cash flow FCF yield of roughly 5.5%. That's pretty solid.
And their target of converting over 10% of sales into cash suggests strong future potential too.
It does. Strong, sustainable FCF is a fundamental driver of value. And the dividend yield provides a direct return. That proposed $2.50 per share dividend for 2024. Based on recent prices, that's a yield of around 2.2% to 2.5%.
And the fact they maintained it through the tough times gives it credibility.
Absolutely. Dividend stability provides valuation support, especially for income-focused investors, and signals management's confidence in the underlying business.
We keep coming back to synergies. For a merger this size, actually delivering on those promised savings and revenue gains is absolutely critical. Let's focus on synergy realization and integration risks.
You're right. It's central to the investment case management needs to deliver here. They've set a clear target, achieving a total contribution of $350 million to adjusted EBITDA annually for merger synergies once everything is fully implemented.
And that's broken down into cost and revenue synergies.
Exactly. Roughly half, about $175 million, is expected from cost synergies. This comes from optimizing the combined organizational structure, reducing duplication, getting better deals through procurement savings, and streamlining the supply chain and manufacturing footprint.
When do they expect to achieve the full run rate on those cost savings?
The target is by the end of year 3 post-merger, which puts it around mid-2026.
Okay. And the other half, the revenue synergies, also $175 million.
Yes, another $175 million contribution to EBITDA, which they expect to come from generating an incremental $500 million in annual revenue. This is the harder part, typically.
How do they plan to get that extra revenue?
Through those cross-selling opportunities, we discuss selling Firmenich products to DSM customers and vice versa, developing truly integrated solutions that combine taste, texture, health, and scent, and leveraging the combined innovation pipeline.
And the timeline for revenue synergies? Longer.
Yes. Typically takes longer to realize. They're targeting the full run rate by the end of year 4, so around mid-2027. The bulk of these, 60%, are expected in TT, then H&C 25%, and PNB 15%.
So how are they tracking against these targets? Are they making progress?
According to the reports, yes. As of the first half of 2025, they'd achieved a cumulative contribution of $165 million to adjusted EBITDA from these synergies since the merger started. That includes over $120 million achieved by the end of 2024.
So they're making steady headway. What about 2025 specifically?
For the full year 2025, they expect to realize about another $100 million in EBITDA contribution from synergies. They'd already booked $45 million of that in the first half, so seems broadly on track.
And crucially, there's that additional benefit from the vitamin transformation program, right? That's separate from the merger synergies.
Very important point. Yes, that program is targeting an additional $200 million in annual EBITDA improvement. It's about making the legacy vitamin operations more efficient.
How much of that has been delivered?
They delivered about $100 million of that in 2024, and they expect to deliver the remaining euro $100 million during 2025. So that's another significant tailwind boosting profits this year, on top of the merger synergies.
That's a powerful combination. But Despite the positive progress reports, there are always integration risks, especially with such different legacy companies.
Always. Integrating two organizations of this scale and history is fraught with challenges. Cultural integration is a big one.
Private Swiss family firm meets public Dutch science giant. Very different styles.
Very different. Getting everyone aligned, collaborating effectively, building a shared culture, it requires careful ongoing management effort. That balanced executive committee helps, but it's a real risk.
What about keeping customers happy during the upheaval? Customer retention risk.
Definitely a risk. Mergers can cause disruption, uncertainty. Competitors will absolutely try to exploit that. Management seems aware they emphasized maintaining customer service and supply security, even if it meant holding higher inventory temporarily in 2023, but it's something to watch.
And key talent retention, especially those creative perfumers, flavorists, top scientists.
Critical. The success of the merged company, especially its innovation engine, depends heavily on retaining these highly skilled people. Uncertainty can lead to departures. They need to manage the restructuring carefully to keep their stars motivated and on board.
And the technical side. Systems integration, merging IT platforms, supply chain systems.
A massive technical challenge, getting ERP systems, R&D platforms, logistics networks to talk to each other across a global organization. It's complex, costly, and prone to delays. Any major issues here could definitely hamper achieving those cost savings and operational efficiencies they're counting on.
Okay, so integration remains a key focus and risk. Beyond that, what are the other major risk factors that dsm-firmenich and its investors need to keep an eye on? What keeps management up at night?
Well, building on what we just discussed, integration and execution risks remain paramount in the near term. Delays in hitting synergy targets, cultural clashes, or unexpected disruptions from the complex A&H separation could all negatively impact performance and how investors view the company.
That makes sense. What else? We talked about raw material price volatility earlier. Still a major risk.
Always. Their profitability is inherently sensitive to swings in the prices of agricultural commodities, petrochemicals, natural extracts. If costs spike rapidly and they can't pass them on quickly enough, margins get squeezed. That pressure can return anytime inflation flares up.
And the economic sensitivity of some end markets, particularly P&B.
Yes. That exposure to discretionary spending in fine fragrance and premium beauty remains a risk. A significant global economic slowdown could dampen demand in those higher margin categories.
Competition isn't going away either, right, from the other big four and niche players?
Absolutely not. It's an intensely competitive landscape. Givaudan, IFF, Symrise are constantly innovating and competing fiercely on price and service. Plus, you have agile niche players. This requires continuous investment just to stay ahead.
What about regulatory changes? That complex global web.
That's a constant operational risk. New regulations in the EU, US, China, or elsewhere could restrict ingredients they use, force costly reformulations, or delay new product launches. It's a significant compliance burden and source of uncertainty.
Currency risks, too. The translation and transaction impacts.
Yes, as a global player reporting mainly in euros, adverse movements in the US dollar, Swiss franc, Chinese yuan, and other currencies can significantly impact their reported revenues and profits, as well as the cost of doing business across borders. It's a volatility they have to manage.
And supply chain and geopolitical risks, still elevated.
They remain significant. Vulnerability to disruptions from geopolitical events, trade disputes like US-China tensions, natural disasters. It's the reality for global supply chains now. Their specific exposure to China as both a market and a manufacturing sourcing hub adds another layer to this risk.
Finally, what about their debt? Debt refinancing and interest rate sensitivity.
While their balance sheet is currently strong, they do carry substantial debt. If global interest rates were to rise significantly again, it would increase the cost of refinancing that debt when it matures or make future borrowing more expensive. That could impact net income and cash flow down the line.
Okay, that's a clear rundown of the key risks. For our final section, let's circle back and take a slightly closer look at the core segments that will define the future dsm-firmenich after A&H is gone. P&B, TTH, and HNC.
Sounds good. Starting with perfumery and beauty, P&D. This segment is really a combination of Firmenich's artistry in fragrance creation and DSM's scientific muscle in personal care ingredients.
Serving everything from luxury perfumes to everyday soap and shampoo.
Exactly. Fine fragrance is driven by premiumization, niche scents, brand storytelling. Consumer fragrance and personal care ingredients are more about performance, sustainability benefits, and delivering appealing sensory experiences at mass market scale.
What are the key trends or opportunities driving growth specifically in P&B?
We touched on them, but natural and sustainable ingredients is massive. That whole clean beauty movement, demand for biodegradable fragrances, renewable materials, upcycled ingredients, their innovations like Clearwood and For Goody directly target this.
And active beauty, the convergence of beauty and healthcare.
Yes, huge demand for ingredients with scientifically proven benefits, anti-aging, skin barrier repair, scalp health, like with Eaterwell hair.
Yeah.
DSM's science legacy gives them a strong footing here. It's about delivering visible results.
And you mentioned regulatory compliance almost as an opportunity.
In a way, yes. As regulations get tighter, especially in Europe and Asia, companies that can offer a comprehensive portfolio of safe, compliant, fully documented ingredients have a real advantage. It becomes a barrier to entry and a reason for customers to partner with them.
Okay, moving to taste, texture, and health. TTH. This seems like the main synergy engine for the food and beverage side.
It really is. This division is all about tackling that core challenge, making food and drinks healthier, more sustainable, affordable, and still delicious. They compete across flavors, texturants, health ingredients globally.
The dominant driver here is clearly health and wellness, sugar reduction, salt reduction.
Absolutely. Providing solutions for taste modulation is key, helping manufacturers reduce sugar, salt, fat without wrecking the taste profile. Their taste print technology is a core capability here, allowing precise adjustments to taste perception.
And the protein transition, making plant-based alternatives better.
Critical growth area. There's a huge need for ingredients to improve the taste, texture, and overall appeal of plant-based meat and dairy. TTH's integrated portfolio flavors, texturants, nutritional boosters is perfectly positioned to help manufacturers crack that code.
Clean label and naturalness also remains vital. Shorter ingredient lists.
Consumers demand it, so strong capabilities in natural flavors, colors, preservatives derived from natural sources are essential. Both legacy companies were strong here.
And helping customers with cost optimization, especially in inflationary times.
That's become a key selling point, too. Providing innovative ingredients like their Maxer and Evi cheese coagulant that improve manufacturing efficiency or reduce reliance on volatile, high-cost raw materials like vanilla or cocoa, it makes them a valuable partner beyond just supplying ingredients.
Finally, let's look at Health, Nutrition, and Care, HNC, the Pure Play Health Science Division.
Correct. This segment targets markets where nutrition has a direct impact on health outcomes, dietary supplements, early life nutrition, infant formula, medical nutrition for patients, and even functional pharma ingredients.
High barriers to entry here, scientific and regulatory hurdles.
Very high. Growth is driven by long-term trends. Aging populations, rising healthcare costs, shifting focus to prevention, growing consumer interest in proactive health management through nutrition.
Key trends and opportunities within HNC, personalized nutrition.
Definitely. As science advances, the ability to offer tailored nutritional solutions grows. HNC's broad portfolio of vitamins, lipids, specialized bioactives makes them a key enabler for companies developing personalized offerings.
Gut health and the microbiome seems like a huge focus for them.
It's a major innovation platform. They're developing clinically validated pre, pro, and postbiotics, like Humiomi, targeting gut health, which we now know impacts immunity, mental well-being, metabolic health. The connections are incredible.
What about early life nutrition? Infant formula ingredients.
A core strength. Providing optimal nutrition in the first 1,000 days is critical. They are leaders in key ingredients like HMOs and those algal omega-3s, Life's Omega, that support cognitive and immune development in infants.
And pharma solutions, how do they play there?
They provide specialized functional ingredients, often called excipients, that are used in drug formulations. These aren't the active drug itself, but they help improve the drug's performance, its stability, or make it easier for patients to take. So, ensuring medicines work effectively. Hashtag outro.
Okay, let's try and bring this all together. We've really covered a lot of ground. We've explored how this merger of DSM and Firmenich created, well, a truly formidable new leader, uniquely positioned right at that crossroads of nutrition, health, and beauty.
And we saw how the last few years were a real test for them. Significant external challenges, that 2023 destocking cycle, the vitamin price volatility. It wasn't easy.
But we also saw a pretty robust financial recovery taking shape in 2024 and into 2025. Driven by, it seems, disciplined execution on their integration plans and those key strategic moves, like the portfolio cleanup, shows real resilience.
And the pivotal importance of that A&H business separation really stands out. That move is set to truly transform dsm-firmenich into a much more focused, less volatile, higher margin company, one that's very closely aligned with those resilient consumer-facing markets.
So looking ahead, the key catalysts seem clear.
Uh-huh.
Successfully completing that A&H separation and continuing to deliver on those promised cost and revenue synergies. Plus, of course, sustained innovation.
If they execute well on those fronts and the market starts to clearly see this more stable, high-quality earnings profile emerge, then that potential re-rating of its valuation multiples, getting closer to peers like Givaudan, becomes the central long-term story.
So what does this all mean for you, the listener? Well, next time you pick up a product, maybe it's a new fragrance, maybe a plant-based meal you're trying, or even just your daily vitamin supplement.
Maybe take a second to consider the intricate, science-backed journey of the ingredients inside it. It's really a testament to how these fundamental components, often unseen, dictate so much of our daily experience.
Now think about this. How might a company like dsm-firmenich, with its really deep integration of sensory science and nutritional science, not just meet current demands, but actually anticipate the future? The future of consumer demand for products that have to be both healthy and pleasurable.
What kinds of completely new innovations could emerge from that unique intersection in the years to come? How might it shape the way we eat, the way we care for ourselves, even the scents that define our spaces?
It's a fascinating thought to ponder, isn't it? Oh, what the future might taste, smell, and feel like.